It is easy to get on short-term market narratives and become impatient. At times, investors lose sight of their broad-based portfolio objectives and let external noise get into their heads. However, sometimes it's important to have a bird's eye view to envisage the bigger picture. The bigger picture. This is the topic for today's AAA Investor Connect. To present this, I would like to invite our founder and managing director, Mr. Rajesh Kothari. Welcome, Rajesh. Rajesh, you are on mute.
Thank you, Sandeep.
Rajesh, I've seen there are many new investors and partners listening to you for the very first time, I think. I'll request you to give some brief highlight about our investment philosophy, protect capital, create wealth, and then you can take the topic of the bigger picture. Over to you, Rajesh.
Thank you, Sandeep. Good afternoon, friends. Welcome to you once again to our AAA Winner Series webinar, the AAA Investor Connect webinar. And this is the initiative we started quite some time back to make sure that we update investors about our views on market outlooks, the strategy, what we are doing, the philosophy, the process, and of course, update on how do we see the market from here on. What I will do is that, as Sandeep has requested, probably for first 5-7 minutes, let me talk about how we do the stock selection, what is our investment philosophy while creating a portfolio, what are a few important USPs at Alpha Accurate Advisors, and then straight we move into the heart of today's topic, equity market outlook, avoid the noise and focus on bigger picture. With that, let me share with you a few important slides of today's presentation. Friends, at Alpha Accurate Advisors, people keep asking what are the USPs of AAA. And when it comes to USPs, the three important things are I am founder and I am fund manager. So while all fund managers are great, they keep changing their jobs, whereas in our case, there is zero risk of changing guard. Second, very important is it is a client-centric business model. We are not into any other business, so no conflict of interest. And third, very important is we are doing this PMS from almost 14 years now. And in last 13.5-14 years, we have delivered 18.4% compounded annualized returns compared to benchmark returns of 12.3%. This is another year where we got award as a best multi-cap PMS in India award by PMS AIF World, methodology by IIM Ahmedabad. When it comes to our investment philosophy, it's pretty simple, protect capital and create wealth. And to protect capital, what is very important is the risk management. And three important risks, be it governance, be it technology, or be it business cycle, can be reduced only with the tool of diversification. We strongly believe that diversification helps you not only to reduce the risk at the portfolio level, but actually it also helps you to create alpha in the long term. Second important is we never follow a model portfolio approach. We buy today what we like today. And third, something very important is focusing on not only what to buy, but implementing disciplined exit strategy. When it comes to stock selection, we have a 3M investment approach. Market size, buy the companies where size of opportunity is huge. Market share, buy the companies where companies are market leaders in their respective sector, and margin of safety is nothing about the valuations. When we look at our portfolio companies, typically we look at the businesses. If it is for our flagship plan IOP, we prefer companies with minimum 100 crores plus profit. If it is our mid and small cap budding beast, we look for profit of about 50 crores plus companies. And out of 5,000 plus listed companies, there are only 800 companies or so which makes 50 crores plus profit. And of that, if you want to reduce the risk by not taking the leverage companies, then the risk further reduces to 300 companies. And from that 300 risk mitigators, we basically identify 40-50 companies which are real alpha producers. Of course, we have a very thorough forensic assessment as well as the longevity assessment of the business, and post the detailed assessment we buy the businesses, and post that we exit. As I said, exit strategy is something very, very important for us. Coming straight now to the market outlook. Give me one moment. So coming straight to the market outlook, as Sandeep was saying, that the world has a lot of noise, the global rates, the inflation, interest rates, geopolitical situation. At home also, some worries on inflation as the food inflation becomes stickier, and many more such headlines. And I think in that kind of a world where every day the new data are thrown in front of you, what happens? It becomes at times, one basically do focus on what one should focus on. And that's what we try to do every time, that let's disengage from all this macro noise and let's focus on what is happening at our home, India, and look at the bigger picture. And here I would like to present some very important insights into what is happening to corporate India. Because ultimately, the global growth, the global inflation, global interest rates, and so on and so forth, ultimately, it gets reflected into your final corporate earnings. And if we look at this slide, on this slide, we have a median net profit after tax. All figures are rupees in crores. For last 10 years, from 2013 to 2023. And if we look at this slide very carefully, you will observe that the top 100 companies' median net profit has moved from 1,600 crores to 3,400 crores. Almost 2x plus, more than double. And if you look at the mid-cap companies, the 150 companies, the median net profit size from 300 odd crores, it moved to almost closer to 2.5 times, roughly 700 crores. And if you look at the small cap companies, 78 crores, the profit size moved to 263 crores. Almost, I would say, closer to 4 times. And if you look at now the observation number 2, very important is the median profit growth in last 5 years is almost double than the previous 5 years. This is despite 2 years of COVID impact, Russia-Ukraine war impact, and many more such things which happened in last 4-5 years. This is something very, very important. The profit size of corporate India, be it large cap, be it mid cap, be it small cap, has increased dramatically during last 10 years, ranging from anywhere from 2.3 times to almost closer to 4 times. When this profit growth is happening across the size of the businesses, it means the corporate India is becoming more competitive globally, and it also means corporate India is becoming more resilient, because as size of your profit increases, you become more resilient to handle the downturns and the cycles of your sector and also of the industry. One very important parameter when one looks at the market outlook, the first important is what is your earnings? And then the second important is how good or bad that quality of earnings is. What is your leverage? And if you look at last 10 years, across large cap, mid cap, and small cap, as you can see here, the debt to equity ratio has reduced dramatically. BSE 500, the large cap companies, they always had a a very negligible debt, and even today it remains so. They are net cash. If you look at the mid-cap companies, their debt to equity ratio from 0.23, it reduced to 0.12, and now it is further became debt-free, almost net cash positive. And if you look at the small cap companies, you see the dramatic difference even in the small cap median debt to equity from 0.57 to almost close to net debt zero. This is something very, very important. One is your earnings growth. Second is your earnings growth is driven by higher borrowings, or is their earnings growth is driven by reduced borrowings? In corporate India case, across large cap, across mid cap, across small cap, we have seen the earnings growth, very strong earnings growth. And number two, also it is driven by reduced borrowings, reduced leverage. In fact, across large cap, mid cap, small cap, the debt equity has become close to zero. And third very important thing then you ask is what is the sustainability of this growth? So one is very clear that if there is a high earnings growth and if there is a reduced debt levels, this combination is a very, very super combination. And it is this combination normally creates the huge value over the period of time. And of course, as I said, your question would be, what do you see the future? How do you see the next 2, 3, 4 years, whether earnings growth momentum will sustain or not? Friends, from 2002 to 2006, I'm sure many of you would remember that Sensex became 5 times in 5 years. And during that time, the earnings growth became 32% compounded for 5 years. From 2009 to 2019-20, almost 10, 11 years, there was a holiday for Nifty earnings growth. Nifty delivered earnings growth of just 9%. And why I'm saying it is a holiday of earnings growth? Because our GDP was 11%. So if the Nifty earnings growth is less than GDP, it is nothing a great achievement, am I right? And therefore, last 2009 to 2020, earnings growth was on a holiday. And from that winter holiday, corporate India started delivering earnings growth. It is 2021, where we have seen double-digit earnings growth. It is 2022, where we have seen double-digit earnings growth. It is 2023, where we have already seen the double-digit earnings growth. And 2024, the FY24, is a fourth year where India is going to see double-digit earnings growth. First quarter results are already announced, and second quarter, Street is expecting about 18 to 90% earnings growth for Nifty companies. And that means the growth is getting sustainable. And to get more insights into why and how that growth is sustainable, one important parameter to look into it is what is happening on ground. Because ultimately, the CapEx, the capital expenditure, needs to go up. And second, very important, is the consumption needs to go up. We have done a very detailed AAA Investor Connect for capital goods and CapEx twice in last 12 months. And we thought to give you some update on how on ground things are changing. The real estate sector is one very important sector which actually tells you how the Indian economy is moving. After almost, I would say, 10 years of sluggishness, Indian real estate sector is finally bouncing back in last 2.5, 3 years. If you look at the stamp duty correction, it has grown 14% in last 5 months of FY24. And mind you, this is coming on a very, very high base of last year, because during last year, the stamp duty correction went up almost 45%. So on an average, the gray line is the average line, and current where we are, we are almost from 450 to 814 is 70-80% almost higher than last 9 years average. Friends, when real estate moves, it has a huge multiplier effect on the GDP. When real estate sector does well, entire building material, be it cement, be it steel, be it tiles, be it plywood, be it wires, be it pipes, be it cables, everything starts moving. And importantly, of course, real estate is a large employer, and particularly the blue collar workers, employment number also goes up. So it is a very, very significant impact, the very high multiplier effect on the overall GDP, and real estate doing well is a definitely very good news for Indian economy. This is the one thing which will make sure that capex, the capital expenditure side of our economy, continues to do well. Of course, there are many more other factors like data center, renewable energy, infrastructure growth, but one very important sector is the real estate, in which I thought to bring it to your notice by this slide. Second important is what government is doing on its part as far as central capital expenditure goes. And if we look at this slide very carefully again, central government has spent 48% higher compared to what it spent last year. Again, last year was a very, very high base. In April to August 22, it actually spent 2.5 trillion compared to 1.7 trillion April to August 21. So it is a 50% almost growth. And on that 50% growth, central government has spent again another 48% growth. It's a commendable job done by central government. Of course, central government finances are in a very, very healthy shape. The GST collection, everybody was kind of skeptical when number was 1 lakh crore, that will it continue at 1 lakh crore? And today, from 1 lakh to 1,25,000, from 1,25,000 to 1,50,000, and from 1,50,000 to 1,62,000 crores, the GST collections are absolutely very, very strong. So the unorganized to organized, from unbranded to branded, from what I would say kind of a formalization of the sector, everything is basically helped, apart from, of course, higher compliance, adherence to those compliance resulted in very strong revenue for the government. And rightly, they are spending very high on the capex side of it, 48% growth. But central alone cannot do everything. What is also important is how the state capex is behaving. And if you look at the state government also, they are doing reasonably well. In last 5 months, they have spent almost 49% higher growth compared to what we have seen in 5 months, 2023. So in nutshell, central government and state government are doing their best job. On top of it, the real estate sector has seen revival after 11 years. And everything putting that into picture, we believe the capex story will continue to do well. Second important thing, which is very important to check whether our GDP growth and our corporate India profit growth will sustain that high growth. Second important is how the consumption side is doing. And while there are many reports that consumption side in India has got impacted because of the monsoon issues, particularly last year and this year, and also inflation, which is hitting the rural India, and therefore the most consumer companies, particularly on the FMCG side, they are reporting subdued number. And while that is true, one important thing what we are basically probably might be missing is within the consumer segment, how the premium segment is doing. And if you look at the, for example, mobile, 30,000 plus price point smartphone is now 17% of the total handset market. This number was only 4% just 5 years back. From less than 5%, it moved to 17%. And if you look at same thing for passenger cars, the 10 lakhs plus price point from 19% 3 years back, we are now at 45%. And that's a huge shift by the Indian consumer. And this is not only, these are just two examples, but it is across, be it buying a home, where people are moving from affordable housing to a little bit bigger homes, or be it a buying a better car, or be it a buying a better handset, or being a buy a better luggage, or whether one is looks for the overall number of Apple phones. I think everything is moving up. So what is happening is that the mix is becoming richer. The premium products are on a high demand. This is visible across the various segments, including two-wheeler and including the many other building material segments. So this is another very important thing to make sure that GDP keeps doing better and corporate India profit growth keeps doing better. So this is the 2 points which I wanted to share with you, that corporate India profit size is becoming bigger, number one. Number two, it is coming at the back of less leverage, low borrowings. And number three, capex as well as consumption, we are on a right track to make sure that this keeps getting better over next 2, 3, 4, 5 years. Ultimately, when it comes to market outlook, market is nothing but mirror of earnings growth. This is my common slide from last probably almost 10, 12, 15 years. And we believe that the Nifty earnings growth will be double digit over next 2 years, FY24 and FY25. And therefore, we remain pretty positive on overall markets. At what valuations we are buying this? And if you look at the average PE is 19.7 times. Post a new government, 2014, the change of regime, the Modi government, and currently where are we? So we are not premium. We are actually a discount to what it used to be in last 9 years. So, valuations are, in my view, are very, very supporting. And therefore, it gives one more reason that you are buying the high growth, you are buying quality growth, you are buying accelerated growth, and that growth you are buying at a reasonable valuations. If you look at market, where we were exactly 2 years back, market was roughly about 18,900 in October 2021. And as we speak today, we are roughly at 19,800, which is not much. It's about 1,000 points, is about 5%. In 2 years, market has actually done only 5%. But earnings growth has been 20% positive. The GDP growth has been 20% plus. So if you look at, in effect, the market was actually trading at 24 times. And from 24 times, currently market is trading at 18.6 times on a FY25 basis. If you look at FY24, market is trading at around 20 times kind of thing. So the valuations are again have basically compressed. There is a correction in valuation, and in our view, that provides very good opportunity to invest at current levels with, of course, 3 to 5 years of time horizon. With that, let me quickly move to how we are positioned for our 2 important PMS plans: Triple India Opportunity PMS and AAA Budding Beast PMS. If you look at Triple India Opportunity PMS, is a pure real multi-cap PMS, 50 stocks portfolio, diversified across 1450 sectors, and banking and finance is roughly about 28% of the portfolio. Consumer is 16%, capital goods is 11%. Software is 10%, pharma is 6%, and others is roughly 9%. Coming to the sectoral views and outlook, we have been very, very bullish on banking and finance. We have been very bullish on automobile and auto ancillaries, and these sectors continue to remain very high in terms of our overall portfolio. And just a minute, I think slide is changing. Sorry for that. So, we remain positive on automobiles and auto ancillaries. About 3 years back, our weightage was about 6%. From 6%, we closely moved to roughly about 14 to 15%. We see many opportunities within this basket, and therefore we remain positive on auto and automobile ancillaries. Consumer space, we play very, very differently. In consumer, we include not only defensives and FMCG companies, but also proxy to real estate companies like building material companies and so on and so forth. Capital goods is one sector which we have been positive from last 2.5, 3 years. We were early in identifying that the companies are going to get the more order books and order intakes because the capex sector has just started. and currently we are at about 12% of the portfolio. Specialty chemical is one where we used to own almost 10% specialty chemical almost, I think, 1 year back. We have been very bullish on that theme for 3 to 4 years. We made huge money out of them. And from 10%, we are almost close to 0% in last 6 months or so. I think by March, we reduced it significantly. And then again, we sold most of it. So currently, specialty chemical is closer to 0. Software, we remain underweight on software sector. And at right time, on more bottom-up opportunities, we will see how to go about it. Pharma is one sector which we added in last 6 months or so. And again, our call went right. And most of the companies what we bought, they are doing reasonably well. The US generics pricing pressure is getting reduced. And on top of it, on a low base, the domestic pharmaceutical industry has also started to recover. So margins are improving, the growth is improving and resulting into, when we bought it, most of the pharma companies, the valuations were very, very reasonable. Many of them were trading at around 18 to 22 times on a 1 year and 2 year forward. And their valuations were basically about 30-40% discount compared to what it used to trade, during the COVID times. That's one sector which we added in last 6 months or so. In terms of, what I would say within banking and finance, this is a sector where we keep checking on, how to position our portfolio. And we have a mix of private sector banks, public sector banks, PSU banks, that's PSU banks, as well as a few NBFC. So that makes up our overall banking and finance. One important thing I always talk about is the portfolio characteristics, because I strongly believe that it is the input which drives output. As I said, it is a true multi-cap, and all of our portfolio companies, they all are large companies when it comes to their profit size. In India, there are 5,000 plus listed companies, and of that, only 600 companies makes 100 crores plus net profit after tax. All of our portfolio companies, they have a large profit size, 100 crores plus profit. In fact, 75% of the portfolio companies have net profit size above 500 crores. When it comes to balance sheet, most of our portfolio companies, they are either debt-free or they have a debt equity less than 1 time, making it a very, very strong business mode. High revenue, high profit, that too, without any overdraft borrowing from the bank, is a rare combination. How this is possible? This is possible because they are true market leaders. Market leadership gives them pricing power and therefore high return on net worth, high ROE, which they reinvest into the business. Earnings growth is very, very critical. And that's why our portfolio kept delivering extremely well. We expect our portfolio to deliver about 24% compared to Nifty earnings growth of about 15 to 16%. So that is about our AAA IOP PMS. In terms of AAA Budding Beast, let me quickly take you through AAA Budding Beast PMS. This is mid and small cap, but the USP of this is we buy only businesses which are large by profit, although they might be classified as a mid cap and small cap. Like if you look at this chart, out of 546 companies which are actually large companies by profit, only 100 companies are classified as a large cap. It means there is a 82% opportunity in mid and small cap. And be it a Timken, which is number one in top 3 companies in bearings, or be it Safari, which is a top 3 companies in luggage, or be it a Polycab, which is a top companies in wire and cable, or be it a Century Ply, which is a number 1 company in plywood. All these companies are market leaders, but they are classified as a mid and small cap because they don't fall into 1 to 100 by market cap. So this is a mid and small cap plan where we basically invest into market leaders with a very, very dominant positioning in their respective sectors. In terms of sectoral allocation, engineering is 22%, auto and auto ancillary is 14%, consumer is roughly about 23%, and software and others and pharma makes up for the others. In terms of the characteristics of this PMS, all portfolio companies are very, very actually large companies. Most of them are 50 crores plus net profit. 82% are 100 crores plus reported net profit. And most of them have zero debt or debt equity less than 1 time. So our thesis remains the same, buying the market leaders, buy the business with a large profit size, buy the business with a zero leverage or debt equity less than 1 time. And that basically allows you to make high return on net worth, and on high ROE, there must be high earnings growth, because without earnings growth, returns will never come. So earnings growth is very, very critical. So that's how the AAA Budding Beast portfolio is built. And this is the performance of AAA Budding Beast on a 1 month, 3 months, 6 months, 1 year, 2 year basis. It is delivered 22.4% compounded on 2 years basis. And since inception, it is delivered 31.2% compounded, compared to BSE 500 benchmark 17.4, and compared to BSE mid small cap 28.6. Importantly, on risk analytics, AAA Budding Beast beta is less than even BSE 500. The standard deviation is also less than BSE 500, and of course with a very strong Sharpe ratio. The average weighted market cap of our AAA Budding Beast is roughly 29,000 crores. So that gives you some perspective that actually we don't buy any micro company, and that's where probably the more risk is there from the market valuations perspective. So we don't buy any micro company. AAA IOP, in terms of performance, let me also take you through AAA IOP performance. So this is a 1 year, 2 year, 3 year, 5 years, and 10 years, and since inception performance. Since inception, it delivered 18.4% compounding. On 10 years, it is 21% compounding. On 5 years, 15.4% compounding. And on 3 years, 24.3% compounding. In terms of the risk analytics of AAA IOP, again, beta is less than benchmark, standard deviation less than benchmark. And on 1 year, 3 years, as well as 5 years, AAA IOP has delivered very strong rolling returns to the investors, which again emphasize and demonstrates how consistent and less volatile the journey of creating higher alpha, which is also visible in one of the slides where we have shown that how we have done during market downtime. And very happy to share with that in 14 out of 16 such periods where market went down, the AAA IOP PMS has witnessed a lesser drawdown, lesser fall compared to the BSE 500 index. So that is about AAA IOP PMS. And with that, probably we can open up for Q&A. Once again, we are very thankful to you for your valuable time. And Sandeep, we can open up for question and answers. Thank you.
Yeah, thanks, Rajesh. Requesting participants to please post your questions on Q&A sections. You can type your questions in the Q&A sections, and we'll take one by one. Thank you. Rajesh, there is one question. What is your view on banking sector, and within it, how would you see the NBFC in particular?
Well, within the banking sector, as I said, what is happening is that the non-food credit growth, after a very, very long time, we have seen very strong non-food credit growth of 15% plus. And good news is this non-food credit growth has been good double digit for almost, I would say now, more than 14, 15 months. And if my memory serves me right, this happening after 12 years or so. So after 2007, 6, 7, probably it has never happened. So it is after a very long holiday, we have seen non-food credit growth improving. That again gives us confidence that overall economy is going to do better. It also gives us confidence that the lender is willing to lend, because there was an issue earlier where a lender was restricting himself in the fear of whether credit is good or not. And it also gives us confidence that borrower is willing to borrow, because as your capacity utilization moves up, you will be definitely you will come to bank for incremental borrowing, or of course you will raise equity. So overall on banking and finance, we are reasonably positive. Your loan book growth is going to remain good double digit, number one. Number two, your credit quality is one of the best in last 12, 14, 15 years. And number three, very importantly, the valuations are also quite reasonable. Within banking and finance, from last 5, 6 months, we have turned more positive between them on NBFC side. And on NBFC side, we believe that probably after December quarter, the net interest margin, which was a kind of a challenging for NBFC, because what happens when you are NBFC, you are repricing of your assets versus liability. There is a lag compared to bank, because in case of bank, it is an immediate pass on of the cost. Whereas in case of NBFC, that doesn't happen. And therefore, the net interest margin, which is called NIM on the banking parlance, that basically got compressed on NBFC side. So we will see reversal of that starting probably from the third quarter and or fourth quarter onwards. So credit growth is strong even for NBFC, but net interest margin was compressing their profit growth. Credit quality again is reasonably good for select NBFC. Of course, you need to be selective when you do it. So I think NBFC will equally do very well compared to banks within overall banking and finance. And within banks, as I said in my presentation, that we are fairly positive. In fact, we bought even public sector banks. We are holding roughly 5 to 6% PSU banks in our portfolio, apart from the private sector banks. So that's our view on banking and finance.
Thanks, Rajesh. Mr. Balaji asking, how are we playing the logistics sector, especially the dedicated freight corridor?
Basically, logistics sector, just a minute. Can you give me one? Just a minute.
Yeah.
I don't see it moving.
Rajesh, you are on mute.
Yeah. So coming to the logistics sector, right now we do not have any direct exposure to any of such companies within logistics. So currently no direct exposure, but we are playing through, indirectly, because see what will happen. It would also have its impact on the overall automobile sector. It will also have impact on between light commercial vehicle to medium commercial vehicle to high end of the commercial vehicle. So there are a lot of things within it will also impact on the across the sectors. So currently we don't have any direct exposure to logistics sector.
Thanks, Rajesh. Next question is from Mr. Rajiv. Considering election round the corner, what percentage price swing on up or down will follow, and what returns we should expect in next 3 years compounded?
On the first question, I think we all need to go to astrologer to predict what will be the outcome and therefore what will the market movement. But I think one thing I can tell you is that I'm sure everybody in this room will agree that the voter knows the best. Am I right? And we have seen historically that state election outcome can be different compared to the central election outcome. So voter exactly knows to whom to select when it comes to state and to whom to select when it comes to center. And if history has any guide, I think the effect of election outcome on the market is probably significant closer to the announcements of results, pre or post, either, correct? But moment you have a little bit longer time horizon, I think that effect fades away. And last but not least, I think what is important is that better benchmarks are getting set. What is important is that reform is an irreversible process. What is important is that the corporate India, the entrepreneurs of India, it is there, they are driving the GDP growth. And I think that will continue irrespective of which government comes into power. People might have different perceptions about different outcomes, and who knows what will happen. But I'm reasonably sure, because corporate India has delivered during different political regimes historically. Yes, the pace of growth can be improved upon if there is a better willingness and better political will to take the country ahead. But otherwise, I don't see any major significant effect on the 3-year view. As he rightly asked, what is my expectation for next 3 years? And I always say that market is mirror of earnings growth. The answer should be, or rather the question should be, do you think corporate India will deliver 12% plus earnings growth for next 3 years? Going by the real estate doing extremely well, the capex cycle doing reasonably well, the consumption within that, the premium mix is doing extremely well. I think earnings growth, if you ask my personal view, will remain good double-digit earnings growth over next 3 to 5 years.
Thanks, Rajesh. The next question from anonymous attendee. Okay. A lot of export-oriented countries are facing a lot of headwinds. Is your portfolio factoring this? And the second question is from the same is that what would be the impact of highest interest rates on real estate and private capex cycle?
Good question. So you're, answering, second question first. So impact of high interest rates. I think it is not that very high interest rates in India. Yes, interest rate is a little bit moved up, but it is still not very, it's not like it moved to that dangerous zone that it will start impacting in a significant way to the demand side, be it a consumer demand, be it a corporate demand. If the inflation remains sticky and it further increases, then definitely interest rate remains the one important risk for the corporate India growth, overall country growth, and of course, to that extent, on the market valuations and growth. What was the first question, Sandeep?
A lot of export-oriented countries
Yeah.
are facing a lot of headwinds.
Yeah. So I think
portfolio factoring this.
Yeah, so I think markets are always ahead of curve, and you are absolutely right. So if you look at March 2022, when Russia declared war against Ukraine and the crude price went up and the inflation started going up, the US Fed announced its war against inflation in March 22. So we sold IT stocks, the software sector, March 22 from 15% or 14% weightage to closer to less than 8% or 9%. So you need to be a little bit ahead of time. You can't act when everything post-facto analysis. That's not the way in which equity markets are always a little bit ahead of time. So I think if you ask my personal view, there is some impact on export. It varies from sector to sector. What are the two biggest sectors where impact can be highest? The one is the IT sector, that's software. And second is probably sectors like textile. Now, IT sector, stocks are already down 40%. So from here on, your question should be we relook at IT as a valuation becomes more reasonable? So we are evaluating it again, correct? Textile, we don't have much exposure. In fact, after what I would say, with the fear of slowdown, we never had any textile company. But finally, in month of April or month of May, we added one company in our portfolio in our AAA Budding Beast, and that company is almost up, I think, 55% from our purchase price, since month of May. So you need to be a little bit ahead of time. Third is you look at the other sectors, which are export sectors. There are many players which are enjoying the China plus one benefit. There are many companies which are enjoying Europe plus one benefit. So I think painting everything with the same brush will not give the desired outcome. You need to be selective. You need to avoid the sectors which are directly linked to the US consumer. At the same time, you should look at the businesses where they are going to become the biggest beneficiary of supply chain, China plus one and Europe plus one. That's how we are playing, for our portfolio companies. So like we have portfolio companies that are getting tremendous benefit from exports because the global companies, the parent companies have decided to invest into India. They've decided to outsource more from India as they are reducing their procurement from, China and other economies. So it varies from company to company.
Thanks, Rajesh. Mr. Parikshit Shah is asking, for your Budding Beast portfolio, what would be the right tenure one should consider?
What would be the
right tenure one should consider?
The tenure.
Investment horizon.
Investment horizon. I think for any mid and small cap product, I always say your minimum horizon should be 5+ years. That is the right horizon because markets are never one way. Particularly mid and small cap volatilities are a little bit higher compared to the multi cap and large cap. And during those times, you should not feel pain and you should not press the panic button. You need to have the stomach to absorb the volatility, and therefore 5 years is the minimum time frame for our AAA Budding Beast.
Thanks. Mr. NV is asking, in IT sector, your outlook after two major results, next 2 or 3 quarters muted, or your view, share please.
I think IT sector is what I would say ever-changing outlook because it is a tremendously dependent on US data dependent. So while of course the base demand, the robotics, AI, digital, cloud, all these things definitely will lead to better demand growth. on one part of your business. On the other side, there's a legacy business where there's going to be some pressure. Clearly, the US consumer may not be in the best of your health. The US banks, they are having pressure. So I think if you ask my personal view, we are still underweight. The benchmark weight is closer to 14% or so. In our IOP, we are roughly about, closer to 9.5%, 10%. In our budding beast, we are still even lower number than that. So we are still underweight. We are monitoring that situation and we will act depending upon how do we see the valuation and any change in the growth numbers from the current numbers. We always ask the first important question, what is priced in? If everybody says that there is going to be zero growth is then factored into. Whether the companies will report -5%, that's the question what we ask ourselves. If everybody in March 22, everybody said IT companies will do 25% compounded growth for another 3 years. And the valuations were 40 times, 50 times, 60 times for many mid-cap IT companies. They were trading like FMCG companies. In fact, there was a very big research report which said why IT companies cannot trade at FMCG companies' valuation. And we said these both are wrong. The growth is not going to be that rosy, and the valuation definitely will not remain like this. We sold IT stocks. Today, we are asking ourselves whether market is already factored into the pessimism of US economy. We don't have the answer, but we are evaluating it closely. And depending upon how do we see the growth going ahead, we'll be stock selective, very, very important in IT sector in particular, and then we'll take the call.
Okay, thanks, Rajesh. Mr. Rahul Sudke asking, does small cap segment on overall basis look overstretched compared to Nifty? There has been 20% CAGR performance difference between two segments post-COVID.
You are absolutely right. So very good question. I think, again, what is important is when one looks at small cap, there are probably 3,000 companies. See, 100 companies are called large cap. Another 150 companies are called mid cap. So that is total 250 companies. Total 5,000 companies are listed. So from 250 to 5,000, everything is called small cap. And that's where probably, investor goes wrong because you cannot paint everything with the same brush. If you look at the small cap and if you look at the top 300 companies, so first 100 large company, next 150 is a mid company, and if they take another 150, 200 companies, they have done superly well in terms of the earnings. They have done extraordinarily well in terms of deleveraging. They have done significantly better when it comes to return on capital employed. Let me give you one data point. In FY12, 2012, 10 years back, small cap ROC, return on capital employed, was 12%. Large cap ROC was 17%. Gap of 500 bips. Today, small cap ROC is 17% and large cap ROC is about 17.5%, 18%. That 500 bips difference in ROC between large cap and small cap has now become almost zero. When that is in the process, when the underlying balance sheet has changed, when underlying ROE has improved, whether the small cap valuation will expand? Definitely it will expand. It's like any other company. So if you ask, for example, a particular company, say company X, and it is growing at a 30% compounding with a 20% ROC, but it used to trade at 10p 10 years back. Will it trade at 10p today? Definitely not. It will trade at 20p. Correct? So I think there are many companies, good companies, which are delivering very solid growth with a very solid balance sheet, with a very solid cash flows. And therefore, the valuations definitely have moved up, but it may not crash. Will it correct by to some extent? 100% possible. But otherwise, it will not crash. It is not a bubble zone yet. Be it a mid cap or be it a small cap, we are not in bubble zone. Definitely not in bubble zone. And there is a fundamental improvement. But yes, if you ask me the micro cap side, the 10 crore profit making companies, 6 crore profit making companies, the SME side of it, few companies where there is a word defense, or few companies where there is a word kind of like something related to railways, and the stocks have moved up by 300, 400, 500, 900%. Definitely, those are the things where there is a bubble. So you need to get out of it. You need to make sure what you are buying into it before you, take your decisions. You need to be really wise on that. As far as AAA budding beast goes, we don't buy any small company by profit size. We buy only market leaders. Correct? We buy only if the business have a low leverage or zero debt. We buy business with 18-20% ROE. We buy business with 18-20% earnings growth. So, as I said, average weighted market cap of our budding beast is roughly 29,000 crores. So I don't see too much of bubble, this kind of a companies which we are looking at in our mid and small cap. And therefore, one should not be too much apprehensive about that it has delivered 18% compounding return. That's fine, because there is an underlying change in your balance sheet and ROE. The question is, can you think that company, whatever you have in your portfolio, can it deliver another 20% earnings growth? And if answer to that question is yes, probably it warrants to continue to hold in your portfolio. And of course, if you think the valuations are bubble, get out of it and buy something better. And that's what we believe in. You need to be cogite. You need to be quality conscious in what you are buying into. And then you must have the exit strategy to get out of it, like chemical. So we sold entire chemical. The valuations change from 20 price to earning multiple to 40, 50, 60 times price to earning multiple. And we said this growth probably will not come through because the raw material cost in China and many other factors. And we sold entire specialty chemical, be it a mega company, be it a large company, be it a mid cap or be it a small cap. And most of these companies are down today by 15, 20, 30, 40% in a matter of just 4 or 5 months. Correct? So yes, you need to be cogite, quality conscious, and be agile, irrespective of the market cap which you own.
Thanks, Rajesh. I think Mr. Vivek Naran's question is on the same line. There is general feel that small and mid cap segment is becoming overrated and cannot continue current returns in future. What are your view? I think the same.
No, I think it is already answered. If we are not yet in a bubble zone, the short answer is whether valuations have moved up. Answer is yes. Why the valuation is moved up? Earnings growth is improved. Why the valuation is moved up? The balance sheet is improved. Why the valuation is improved? Because ROE is improved. Can it sustain the high valuation? Question is how much it can go down? 10%, 15%, 20%? Or do you expect a 30, 40, 50% crash? We don't think it will be a crash. There can be time correction. There can be price correction. As far as AAA budding beast PMS goes, we are advising investors to do, kind of a staggered approach, STP approach. Maybe 30, 40% you do today, and the balance you spread out over next 4, 5, 6 months to take advantage of any time correction or price correction. And for AAA IOP PMS, I'm just anticipating there will be a question. We recommend lump sum investment as we are still reasonably positive and bullish on the market in general.
Thanks, Rajesh. The next question is from Mr. Brahmanand Hegde. What do you feel is the impact of Israel-Hamas war on Indian market? What precautions you are taking till war subsides? I think Govind sir is there.
Yeah, Govind is there.
Govind sir.
Okay, so thank you, Sandeep. In my view, this war which is going on as of now is very, very localized. And while I do not have the data to substantiate, our trade with Israel is also very limited in the overall context. So do not see any bigger impact or any material impact on Indian economy or on the markets. There is some exposure with respect to IT, but which is very, very small. And also pharma, again, it is very, very small. So not very concerned about the current ongoing war on the Indian economy markets. However, if this escalates into the bigger war where other countries also get involved, then again, we will have to evaluate. But as of now, not very concerned about it.
And just to add what Govind has said, this particularly Israel-Palestine, I think is a 100 years old thing. It is an ongoing thing from last so many years. At times it gets more, what I would say, a little bit, retaliation is a little bit high. At times it becomes silent zone. But I think every year there's so many things between going on. It's like North Korea, South Korea, they keep fighting. So beyond a point, we are avoid the noise. That's what we say. And if on such news, if market corrects, don't worry, have 2-year, 3-year, 4-year view and buy it with two hands. Because these are the news what will create opportunity. And this is the opportunity what you need to seize. Don't waste the opportunity. If such opportunity comes, who knows? Tomorrow headline can be different and market might be down 10%. Who knows? Take it the opportunity. Don't worry on that day. On that day, just buy. Don't even call us. On that day, you need to show the courage, because those are the times if you exercise your right to buy, your compounding returns can be significantly better than otherwise normally, what you get from the any product for that matter.
Thanks, Rajesh. Thanks, Govind sir. Another question, in fact, I think it's also US. Yes, Govind sir only. The US slowdown is the US slowdown is real. Interest rates are at 15 years high. Impact of US economy, impact on the US economy, or the recession is on the corner. Govind sir.
So, well, I was expecting this question because it is there in the minds of many. And when we meet investors or prospective investors or our partners, this question has been coming time and again. So the interest rates, as we all know, are at 15, 16 years high in US, which is 10-year G-Secs. And mortgage rates, which is 7.5%, they are almost 30 years high. What we have seen, while the inflation has corrected significantly from over 9% to 3.5% or less than 3.5%, there were 2-3 sectors which were very, very resilient. First and foremost is the labor market. Labor market, which data comes every month, and everyone knows the unemployment rate is 30-40 years low at 3.5% around. So, and the job additions every month, that also is exceeding the expectations of the analysts. For example, September month job additions were more than 3 lakh against the expectation of 1,60,000. So labor market continues to defy all the logics. On the wages growth, wages are still growing at 4.5%, which is now higher than the inflation. So there's a real income growth for the US citizens. So from that perspective, and it is a very, very big and important parameter to evaluate. So this is because that leads to the consumption growth in the US economy if they have a positive real income growth. Second important factor, which was very, very resilient and still is quite resilient, is the real estate. Real estate prices, while they had corrected, but they were showing a lot of resilience in terms of the overall market. However, of late, just last few weeks, we are seeing corrections in terms of new construction house, in terms of new buyings, and the office vacancy has also increased significantly. In fact, my view is this was one of the objectives of Fed Reserve to sustain the higher interest rates. What we call it is the higher for longer, because that was one sector which was not coming down, and now probably that will also come down. Also, if you recall, the lot of global strategists were expecting the recession in US economy in the second half of the current calendar year, which has not happened. So the narrative has changed from recession to maybe a mild correction in the economy. Also, if you look at from a different angle, what was expected pre-COVID, that whether the economy, when the COVID hit the global markets and economies, whether the economies would go down or recover. US is one of the only large economies which is in 3 years is positive growth. Most other economies are still showing negative growth. So that shows the resilience of the US economy. Having said this, the higher interest rates of 5% or so will definitely impact the consumption, will also impact the real estate. But one big change which has happened is the composition of the economy. If you see, and also the markets, if you see the top 7, 8, 10 IT companies, now they are commanding nearly 30% of the indices. And that is one of the main reasons we are seeing that the earnings growth is also resilient and markets are also resilient. The valuation multiple of the markets have also gone up. So net, to summarize this, while there can be some slowdown in consumption, there can be some slowdown in real estate, the discretionary spending, which is being done by many large corporates on the IT, that is also getting postponed, which is reflected into the results and commentary by our two large company, TCS and Infosys. So there is some slowdown, but overall, US economy is quite resilient. And from Indian perspective, as Rajesh has mentioned in the call, like textile and IT we did talk about. He has covered textile also. And wherever there's a specific company which has got very high exposure to, say, US economy, that may get impacted. But most Indian companies which have, say, exports as a significant revenue, they are getting benefit of China plus one, Europe plus one, which Rajesh elaborated some time back. So net, we are not seeing any big impact of that as of now on Indian economy, Indian markets. But yes, US economy can slow down a little bit from here.
Thanks, Govind sir. Another question from Mr. Anand Raju. How does AlfAccurate determine the allocation of assets within the portfolio in relation to upcoming elections? Again, the speculative question, I think. What factors or indicators does AlfAccurate consider when assessing the potential impact of nearby elections on the portfolio?
Well, I think, first and foremost, what is important is if you want to basically look at the portfolio from the changing policy stance, correct? Because elections means risk of change in regime. And risk of political regime means might be change in the policy stance. And if you look at our portfolio, apart from banks, and banks by and large don't get influenced by the political regime, we have a zero exposure to PSU oil and gas, which is the most sensitive sector for the economy and for the politics. The farmer at the center and consumer at the center. So in oil and gas, let's assume if tomorrow suppose crude moves to say 120, of course the government will not allow oil price, fuel price, petrol and diesel price to move up to that level to protect the consumer. And once they do it, it means the marketing margins of oil marketing companies will not go up. In fact, they will bleed. Or for that matter, even the oil producer, like companies like ONGC or companies like that, they will also bleed, correct? So we have a zero exposure to that, number one. Number two, keeping in mind the farmer. So it means the fertilizer policy of the government. So we have zero exposure to PSU, public fertilizer units. Number three, the metals, where change in government or change in policy stance. I think forget government, change in any policy stance, which is led by any government, correct? In metals also, they do control, like anti-dumping duty gets revised, the import duty, export duties get revised. We have zero exposure to any metal stocks, be it PSU or be it private, and so on and so forth. So if you ask my personal view, our PSU, so-called PSU exposure is primarily through banking and finance, roughly 5.5% of the portfolio, and might be 1 to 2% of the portfolio might be in defense. They already issued the order book, and therefore those orders are, a good part of the order is from the India, as well as incrementally from the exports, and therefore they are also not at the risk. So I don't see any major risk as such, company-specific risk to my portfolio companies because of any major change in such kind of a sensitive sectors.
Thanks, Rajesh. Another question, Mr. Satyan Bhoidar. How do you see the non-ferrous metal sector and pharma sector, the sectoral outlook?
Pharma, we already talked that in month of, from last 6 months, we are turning positive on pharma, very, very selective. The US, generics, the competition is reducing. Many plants are closing down globally. China is also major a problem. And therefore, the pricing pressure, which was very, very intense, that is basically has reduced. And that definitely gives benefit to Indian pharma companies. That's number one. Number two, the domestic pharmaceutical sector, after a very, very subdued growth, has revived and now witnessing 8, 11, 12, 13, 14% kind of a growth, depending upon the different segments. Number three, the margins which were under pressure because of the lower generics prices, that pressure is off, and therefore the pricing power and profitability has also improved. The combination of these three factors, and therefore we are positive on the select companies on pharmaceutical sector. We have added about roughly 5 to 6% of the portfolio in our IOP, as well as in our budding beast and as well as in focus. We have added our pharma exposure in last 6 months. Coming to non-ferrous metal, we don't have any very strong views on metal sector. Most of the times we avoid metal sector because, as I said, there are a lot of factors which are not in our hand, they are not in our control. The crude price, the currency, the tariffs, the import duties, the export duties, the import duty levied by the other countries or Indian products, nothing is in our control. And therefore we try to avoid the sectors where our ability to predict is very, very limited. So currently we have no exposure to metals.
Thanks, Raj. There is another question. Rajesh, we have been told that diversification kills the alpha, and you, with your performance, you busted this myth over the years. Want to understand more on this from you?
So friends, I think it is very, very common. Everybody knows one thing, that diversification helps to reduce the risk. I think everybody knows about it. But I think it is unknown or lesser known, let me put it this way, that diversification actually helps you to create huge alpha. And let me spend a minute on this, why this happens. Because India is a different economy. As I always say, in India, there are 5,000 companies, and out of 5,000, only 600 companies makes 100 crores plus profit. Only 600 companies, less than $10 million profit. That's it. Only 600 companies make $10 million plus. So, historically, India is a capital-starved economy. Indian entrepreneurs never had that kind of a capital, and bankers were not willing to fund them. Neither we had a venture capital. So what Indian promoter used to do, they used to put their 10, 20, 30, 40 crore, 10, 20, 30, 40, 50 years back and invest it into one particular segment. So for example, if you go to Europe and you want to buy a specialty chemical company, you buy, like for example, BASF. If you buy BASF, you are buying not one chemistry, you are buying a basket of chemistry. You are not buying one plant, you are buying 4, 5, 6, 7, 10 plants which are there globally. You are buying 200 plus customers which they are supplying. You are buying 200 plus applications which they are manufacturing. But come to India, and if you want to buy specialty chemical, like for example, if you want to buy fluorine, there are only 3 companies: SRF, Navin Fluorine, and Gujarat Fluorine. If you want to buy rubber chemical, there is only one company, NOCIL. If you want to buy chemical backward integrated API plus player, you have only one company, RT Industries. You want to buy food additives and related, you have probably only one company, Fine Organics. Every chemistry, you only 1 or 2 players. On top of it, everybody has primarily India chemical companies have only 1 or 2 plants, might be Dahej or Tarapur or something like that. So God forbid, if suppose something goes wrong, environment pollution or anything, then stock will go down 30, 40, 50%. So when you want to play in India specialty chemical, like that's what we did. When we used to have a 10% exposure, it used to be across 5 companies. So by buying 5 companies, we played fluorine, we played rubber, we played food additives, we played API backward integrated, we play ATBS to Vinati Organics, which is number 1 in the world with 65% market share, only one segment they operate in. We play across 5 chemistries, across 5 plants, across 5 management. By doing that, definitely it helped to reduce the risk. That's one part of story. But it also helped us to participate in 5 different chemistries, and therefore the huge alpha got created. Same is, for example, say building material. So you don't have a single company in India. Suppose you are very bullish on real estate and building material space. You don't have a single company in India which is into plywood and tiles and pipes and wires and cables. No. You want to buy plywood, there are only 2 companies in India. You want to buy pipes, there are only 4 companies in India. You want to buy wire and cable, there are only 3 companies in India. You want to buy tiles, there are only 4 companies in India. There is not a single company which is available in all 4 segments. So what we do, we buy 4. So in 2020, post-COVID, we bought almost 6-7% into building material. We bought largest company in plywood, we bought fourth largest in pipe, we bought largest company in wire and cable. We bought 4 companies. And most of them did extremely well, correct? Instead of buying one company and then relying on, if I'm buying a tile company, I have to predict the natural gas prices. If I'm buying a plywood company, I have to predict the China imports. If I'm predicting buying the pipe company, I have to predict PVC price. So instead of that buying 4, mitigate the risk of such unknown thing and still keep delivering alpha. That's how we always believe. Diversification actually helps you to create very long-term superior alpha with a lesser risk. That's the beauty of diversification.
Thanks, Rajesh. Another question. There are many multiple questions from one. How does AlphaGrade actively rebalance the portfolio based on election-related news or events? If so, what is the frequency and criteria for rebalancing?
As I said, the 2 important mantras, one is what to buy, that's quality, and second is be agile. Be it election or be it no election, be it Russia-Ukraine war or be it a COVID. We need to assess at every point of time what growth I'm buying into and at what valuation I'm buying that growth. If there is any change in underlying assumptions due to any reasons, external or internal to the company or to the management, we need to rebalance, exit the portfolio. So when you say rebalance, if 3% becomes 5%, we of course reduce to 3%. When we believe the target valuations are achieved, we get out from that company. And when we think that we are going to go wrong in our assumptions, which we have assumed for company's growth, we exit the company. So these are the 3 parameters what we use. For us, it is an everyday process. Every day we keep evaluating, are there any change in underlying assumptions, whether the underlying assumptions are going to be met, or we do a margin of safety at current valuation. If answer to that question is no, review it, change it. If answer to that question is yes, keep buying it if you are bullish on the growth, irrespective what is the stock price. If you are bullish on growth and you are getting a right valuation, even if stock price is down, not a problem, you keep adding to that portfolio. So that's how our exit strategy, our causality is working. And it is that causality which results into the less drawdown during the downtime and high upside during the good time.
Okay, thanks, Rajesh. Another question from Mr. Pranit Shetty. How will rising bond yields and globally rising raw material input material cost will affect the Indian market in short and long term?
Well, long term is very difficult to predict what will be the long-term bond yield and what will be the long-term raw material prices. But as far as raw material prices, it is coming down. It is not going up. So if you look at it, in fact, the gross margins of corporate India, it is moved up in first quarter and second quarter because raw material prices are now coming down. China has opened up fully. Many chemical prices are down 30, 40, 50%, and that's across the board. So raw material prices currently is not a problem. It is a tailwind rather than headwind. If a question is what if the raw material prices started going up, then what happens? Definitely is negative, and therefore you need to buy the businesses which have a pricing power, ability to pass through the rise in raw material cost to your end customer. As you are aware, all our portfolio companies, they are market leaders, and therefore their ability is the best of the ability to pass on such hike in cost to the customers, maybe with a lag of 3 months possible, but otherwise they have a significant capabilities and business mode to pass on the price increase. So I don't see, currently if you ask me, that's not the risk. Right now it is a tailwind, not a headwind. Coming to the bond yield, rising bond yield globally, I don't know, there are too many global gurus, they come on various channels and they give a lot of view, but when interest rate moved up from 2% or 1%, US Fed, I'm talking about, from 1% to close to 5.5, India interest rate is not moved up like that. So it means definitely Indian RBI has done something right. And definitely US Fed has done something wrong. Am I right? Bond yield is not a function of US bond yield. India bond yield, by and large, 70-80% probably, is a function of how well we manage our accounts. Correct? And that's something very, very important. Otherwise, by now, your INR to USD would have been 98 with 5.5, but it's not happened. It means our resilience, our current account balance, our deficit, and so on and so forth, they are much better managed because our dependence on crude oil to some extent is reducing. Number one. Number two, we got benefit of cheaper Russia crude. Very big benefit. Number two. Number three, the Make in India initiative of government is truly working for exports. Look at our electronics exports. Jump 4x. It has never happened earlier. Our exports are going up. On one hand, exports are going up. On the other hand, our import resilience on crude is reducing. On the third hand, we are getting the cheaper crude. On the fourth hand, our services exports are doing extremely well. Data center and many more such things, KPOs, they are doing extremely well. So our finances are managed in much better way compared to US Fed. And therefore, if you manage your finance well, irrespective of how good or bad the global economy does, would have a limited impact on your Indian economy. And if you don't manage your finance well, irrespective of whether bond yield globally goes up or down, definitely will impact your domestic economy.
I will add to what Rajesh said, just one data point, how India has managed its macro so well. So Rajesh did mention about the currency. So YTD, which is from 1st January till maybe as on yesterday. So Indian currency relative to USD is depreciated by 0.6% only, less than 1%. While Chinese currency is depreciated by 6%. That shows that, and it's not only this, there are like South African Rand, which is also depreciated significantly. So there are many currencies globally also which have got impacted, but India, because of much better managed macro, the currency is also holding quite well.
Thanks, Govind sir. Thanks, Rajesh. The other question from Mr. Neeraj Thakkar. Rajesh, you manage pretty diversified portfolios with 50 stocks and you delivered to really handsome returns. How you manage to analyze all these stocks? Our research abilities, I think he's asking.
Yes, so basically, I think, that's our secret formulas, am I right? You are asking all secret. I think we have a little bit different approach compared to the traditional approach. So, first of all, we buy only leaders, am I right? So we never need to check, by and large, whether the company is existing or not. Like, for example, if you are buying TVS Motor, everybody knows TVS Motor has been one of the largest players, the top 5 players in Indian two-wheeler market. So company is there, promoters are there, plant is there, product is there, bankers are there, auditors are there. Your basic things are there. They already have market leadership, so it is proven. Customer has already accepted their products. So what is important then for you is to keep checking whether there will be sustainable growth or not. That's very important. So what we do is that, on an average, we meet 2 companies a day. On an overall team basis, we meet 2 to 3 companies a day. So we have a lot of value chain kind of an approach. So what we do when we meet a particular company, say for example, a company in banking and finance, we just don't ask about banking and finance. We ask about their view on the consumer lending, their view on auto financing. If they are bearish on auto financing, even if automobile company is very gung-ho, is not going to sell their products because financer is saying that I will not sell automobile due to whatever reasons, correct? So and when we meet auto company, OEM, we ask about auto ancillary companies. That how do you say the rating of Mr. ABC, a auto ancillary company, which is a vendor. So like this, so there are cross linkages between the various sectors, and that cross linkage actually helps the entire team to gain ground on the multiple sectors, on the multiple companies at the same time. And that's very important. And ultimately it is experience, am I right? And there are no shortcuts. Our team, of course, is the combined experience of 85 plus years, and everybody is 10, 15, 20 years into this, doing same thing from last 10 to 10, 20 years. And that's basically how we, look at the businesses, and we go really deep dive when we are analyzing any company. If it is a mid and small cap in particular, we check with customer, competitor, and supplier, and we always want the green signal from them. Then only we meet the management. Forget buying or not. Then only we meet the management. Otherwise, we don't even meet the management. So I think it's very important. The due diligence is very important. In fact, in the opening slide, I talked a little bit about our forensic assessment, how we do that. I talked a little bit about our longevity assessment, which is part of the presentation, which is on website, how we do that. All the stuff, when we combine, that's basically, you see the outcome based on it. But that's very my short answer. Otherwise, it will take probably another 5 hours to explain, how we go about it.
Thanks. That's the end of the question list as of now, Rajesh. Thanks to you. Thanks, Govind sir. All the friends.
Rajiv.
Just a minute. I think.
Just now it's coming. If you can just cover it up.
Just a minute. Question. Just. Okay.
So it's question on, I think there was question I can't see. So basically, this question on how basically what is your frequency of changing the portfolio, the churn?
Okay, churn.
Yeah. So the answer to that question is we don't have any set frequency that we will rebalance on monthly or quarterly or yearly basis. We rebalance as and when required. If it requires rebalancing tomorrow, we'll be acting tomorrow. If it requires to reduce or increase or to completely exit, the next moment, we need to act next moment. We can't wait for it because market doesn't know two things: your date of purchase and cost of purchase. Market doesn't know about it. So you need to act as soon as you know that you need to act. So you need to do very, very prudent, judiciously. You need to act on it and need to change portfolio if required.
Just one question. I think that Mr. SD Naik asking that I think we already answered that question in the call. Govind sir also addressed. What will be the effect of recent Israel and Hamas war, and which could escalate oil prices enormously on our Bharat economy?
So I think that question is already answered.
Yeah, that's already answered.
The second part, as far as what can cause escalation in oil price, nobody knows the answer unless and until it provokes, as Govind has explained. If it it spreads into multiple countries, and then there is a sanctions or ban on, say, Iranian oil or such kind of thing, then that kind of thing will. But look at the recent history of Russia-Ukraine war, and even during that time, we imported Russian oil, correct? So I think we don't see it is an extreme situation. Who knows what will happen under those extraordinary circumstances? If market corrects because of it, take it to your advantage. Add more at such opportunity. Otherwise, these are extraordinary circumstances which probably difficult to predict at this point of time.
Thanks, Rajesh. That's it from the question queues there. Thanks, Rajesh. Thanks, Govind sir. And
Thank you.
Thank you, friends. Thanks for your time and for participating in this call. This is our endeavor to keep you updated on every quarter. This is a quarterly Investor Connect. Thanks, and wishing you the coming time is the festive period starting from Sunday onwards. The Navratri starts. Happy festive period. Thank you. Thanks to everybody.
Thank you, everyone, for your valuable time. Really appreciate all your support, throughout, last 14 years, and wish you, happy festive season. Enjoy to your best and keep creating wealth. Thank you. Thank you, everyone.
Thank you. Stay happy, stay healthy. Thanks.